The vaults are empty, not metaphorically, not in some clickbait, sensationalized, thumbnail-driven way designed to make you click. The vaults are mathematically, structurally, and verifiably running dry. For years, we have sat here and tracked the warehouse reports. We have counted every ounce moving in and out of the COMEX system. We have warned you that one day the numbers would cross a line from which there is no return. That day is not next month. That day is not next year. That day is right now, and the data I am about to show you is the proof. Ladies and gentlemen, Market Cipher here. While you were checking your portfolio this morning, while you were glancing at the spot price of silver sitting at $69.82 and wondering whether to buy the dip or wait for a pullback, something far more important was happening in the plumbing underneath the price, something that changes the entire calculus of this trade, something that tells you the game is no longer about charts and technical analysis and moving averages. The game is now about metal, physical metal, and there is not enough of it. The mainstream media is not going to tell you this, the banks are not going to tell you this, but the exchange's own filings will. We just pulled the latest fully extracted official COMEX silver warehouse report. This is the CME's own filing, dated March 23rd, 2026. This is not a rumor from a Reddit thread. This is not a screenshot from someone's social media feed. This is the exchange itself telling the world exactly how much silver is sitting in its vaults. Total registered silver, the metal that is specifically warranted and available to be delivered against futures contracts, stands at 79,199,547 troy ounces. Total eligible silver, metal stored in approved vaults but not classified for delivery, stands at 252,894,945 troy ounces. Combined total is 332 million troy ounces. Now you need to understand what these categories mean, because this is where 90% of the internet gets it wrong and where the real story lives. Registered silver is metal that has been inspected, warranted, and placed into the delivery pool. It is the ammunition in the gun. It is the silver that the exchange can actually hand over when someone holding a futures contract says, "I do not want your cash. Give me my metal." Think of it as the money in the ATM. It is the only cash that the machine can actually dispense. Eligible silver is metal sitting in the same vault but belonging to private holders who have not offered it up for delivery. It is like cash locked in the safe deposit boxes behind the teller window. The bank cannot touch it. Run the ratio yourself. Registered silver accounts for just 23.8% of the total. Less than 1/4 of the metal sitting in COMEX vaults is actually available to satisfy delivery demands. 3/4 of it belongs to someone else who has explicitly chosen not to make it available. That is not a healthy inventory profile. That is a gas station with 1 gallon left in the underground tank, while a line of cars stretches around the block. The gauge says nearly empty, and the line is getting longer by the hour. And this is where it gets truly dangerous. Pull up the latest CME delivery notice data dated March 27th, 2026. The March 2026 COMEX 5,000-ounce silver futures contract shows a settlement price of $69.54, an intent date of March 27th, and a delivery date of March 31st. The delivery machinery is not idle. It is grinding forward in real time. Warrants are being pulled, metal is being demanded, receipts are being transferred. This is not an abstract concept debated in internet forums. This is happening right now, and the pace is unlike anything we have ever seen before. Let me show you why the pace matters. According to verified reporting for 15 consecutive months through early 2026, physical silver has been exiting COMEX warehouses at volumes the exchange has never processed before in its entire history. December 2025 alone saw 65 million ounces in deliveries. One single month. 65 million ounces. That is not a normal delivery month. That is a bank run on metal. January 2026 followed with 49.4 million ounces, more than 7 times what January 2024 produced. All of 2025 combined settled 474 million ounces of physical silver against 203 million ounces the year before. That is a 133% increase year over year, and registered silver has now fallen roughly 75% from its 2020 peak. Do the math. 474 million ounces delivered in a single year against a registered inventory that now sits at 79 million ounces. They delivered 6 times the current registered inventory in just 12 months. If the outflows continue at anywhere near this pace, the registered category does not just decline, it evaporates. It ceases to exist as a meaningful buffer between paper promises and physical reality. And when it does, the exchange faces a choice that no exchange ever wants to face: default on delivery obligations or reprice the metal to a level that finally rations demand. Now connect this to what is happening 3,000 miles across the Atlantic, because the drain is not limited to New York. The latest official London Vault data, covering the end of February 2026, reports 27,065 tons of silver held in London vaults. That number is down 2.4% from the previous month. The reported value stood at $78.3 billion, and the stockpile equated to approximately 92,177 silver bars. London, one of the deepest physical custody centers on the planet, the vault system that is supposed to be the bedrock of the entire global silver market, is shrinking. 2 different continents, 2 different vault systems, 2 different reporting mechanisms, both showing the same directional signal. Metal is leaving, not arriving. Leaving. And it is leaving at a rate that tells you something structural has changed in the global silver market that is not reversible with a press release, a talking head on television, or a carefully worded statement from a central banker. When 2 independent vault systems on opposite sides of the planet both report declining inventories simultaneously, that is not a coincidence. That is a trend with teeth. Now, let us talk about the price, because the price is the scoreboard, and the scoreboard is confirming what the vaults are screaming. Silver is trading at $69.82 as of this report. Kiko had it at $69.62 on March 27th. FX Street had it at $68.84 the same day. USA Today cited $67.80 that morning. Fortune cited $67.97. The numbers vary slightly because silver moves fast across global exchanges and data feeds are time-stamped differently across time zones, but the direction is unmistakable. Silver is pressing towards $70 with structural momentum behind it. This is not a meme stock rally. This is not a social media-fueled pump driven by emojis and blind hope. This is a market where the fundamental supply-demand equation has broken so badly that the price is being dragged higher by the physics of scarcity, not the psychology of greed. You can see the difference in how the metal moves. Speculative rallies are violent and short-lived. Structural rallies grind higher, day after day, week after week, pulling back only to find higher lows. That is exactly what silver is doing right now. And the ETF layer proves it beyond any reasonable doubt. SLV, the iShares Silver Trust, shows a net asset value of $61.39 as of March 27, 2026. But in the latest session, SLV closed at $63.44. Up 3.27% on volume of 524,000 shares. The market price was trading above the published NAV. That premium is not a rounding error. It is a signal. When investors are willing to pay more than the underlying metal is officially worth just to secure exposure through that particular vehicle, they are telling you something profound. They are telling you that access matters more than price. They are telling you they do not trust the spot market to deliver. PSLV, the Sprott Physical Silver Trust, tells an even more aggressive story. NAV was up 10.03% over 1 month and 30.44% year to date. Market price was up 16.96% over 1 month and 30.61% year to date. The market price is running ahead of the NAV because investors are paying a premium specifically for PSLV's structure. Metal stored at the Royal Canadian Mint, fully allocated, fully auditable. In a market where trust in the system is cracking like dry earth in a drought, custody becomes king. The premium on PSLV is the market screaming, I will pay extra to know my silver actually exists somewhere I can verify. And Sprott is not sitting still. They doubled their capital raise program in January 2026 to $2 billion. At current prices, that is enough to buy approximately 18 million ounces of physical silver. That is roughly 23% of the entire COMEX registered inventory. One institutional buyer, one capital raise, and they could theoretically vacuum up nearly a quarter of the deliverable silver in New York. If that does not make you sit up straight in your chair, you are not paying attention. The whales are not buying paper anymore, they are buying metal. And they are buying it in a size that the system cannot absorb. Now look at the miners, because the equity market is the forward-looking machine that tells you what the smart money truly believes before the headlines catch up. In the latest session, Pan American Silver finished at $51.70, up 5.75%. First Majestic Silver closed at $20.68, up 7.88%. Wheaton Precious Metals closed at $124.70, up 5.13%. These are not routine fluctuations. These are violent single-session surges in companies that produce and stream the very metal that is disappearing from the world's vaults. The equity market is not waiting for the shortage to be officially declared on the evening news. It is front-running the declaration. When miners move 5 to 8% in a single day, while the underlying commodity is pressing toward all-time highs, that is not noise. That is the market screaming that the supply side cannot respond fast enough to meet the demand, and that the companies who own the deposits, who have the permits, who are pulling silver out of the earth, are about to become the most strategically important entities in the global economy. The equity market smells blood in the water and the capital is piling in. And what is driving the demand that is emptying the vaults and lighting up the mining stocks like a Christmas tree? This is the part that transforms the silver story from a financial trade into a civilizational necessity. The solar industry alone is consuming between 200 and 250 million ounces of silver annually. That is roughly a fifth of global supply going into one single industry. Add electric vehicles at 40 to 60 million ounces per year, add semiconductors, add 5G infrastructure, add medical devices, add the massive build-out of artificial intelligence data centers that require silver in every connection point, every solder joint, every thermal interface. Silver is not a pet rock. It is not a relic of a bygone era. It is the electrical nervous system of the 21st century economy, and you cannot substitute it. Period. There is no other element on the periodic table that matches silver's combination of electrical conductivity, thermal conductivity, and reflectivity. You can substitute platinum for palladium in certain applications. You can swap copper for aluminum in some wiring. But you cannot substitute silver in high-performance electronics, in photovoltaic cells, in antimicrobial coatings. It is simply the best at what it does. And the technologies that the entire world is betting its future on, solar energy, electric transport, artificial intelligence, all of them require silver in increasing quantities every single year. The world is building a silver-dependent future on top of a silver-scarce present. Analysts estimate the cumulative silver supply deficit since 2021 at roughly 820 million ounces. Let that number settle. 820 million ounces of structural deficit accumulated over 5 years, while the world simultaneously accelerated its dependence on the very technologies that consume this metal. Every solar panel installed widens the gap. Every EV battery assembled widens the gap. Every data center powered up widens the gap. And the mines cannot ramp fast enough to close it. It takes 7 to 10 years to bring a new silver mine from discovery to production. The supply response is a decade away. The demand is here today. And then China dropped the hammer. In late 2025, Beijing reclassified silver as a strategic material. They tightened export licenses. And after exporting more than 4,000 tons of refined silver in the first 11 months of 2025, they stopped. Not gradually, not with a polite taper and a diplomatic press release. They stopped completely. The world's factory, the nation that manufactures more solar panels and electronics than anyone else on the planet, decided that its own silver supply was too important to share. They locked the vault door and swallowed the key. When a nation that has been supplying metal at that volume suddenly reclassifies it and shuts the export gate, the ripple does not stay inside one country. It reverberates through every vault, every refinery, every pricing benchmark connected to that supply chain. Physical silver in Shanghai has been trading at a sustained premium over COMEX futures for months. The spread has persisted because the metal needed to close that gap cannot easily leave China anymore. The arbitrage mechanism is broken. The bridge between East and West has been cut, and the current is only flowing in one direction. JP Morgan has reportedly been shipping metal eastward at premiums of $10 an ounce or more above COMEX prices, with VAT costs absorbed by the Asian recipients. Think about what that means. The biggest bank in America is paying above market prices to move silver into a country that just declared it a strategic asset and locked the door behind it. That metal is not coming back. It has crossed the event horizon. It has entered a one-way flow that drains Western vaults to fill Eastern strategic reserves, and nobody can stop it. This is not a commodity trade anymore. This is financial warfare. China knows that every ounce of silver that leaves New York and London and lands in Shanghai is an ounce that cannot be delivered against a futures contract. Every ounce that disappears behind the export ban is an ounce that the COMEX can never recover. And they are pressing the advantage. They are squeezing the Western financial system at its weakest point, the gap between paper promises and physical reality. They are weaponizing scarcity. And in early January 2026, the data revealed something that should have been front-page news on every financial publication on the planet. JP Morgan issued 99% of 8.1 million ounces in a single day's delivery notices, while open interest in the contract rose by nearly 1,500 contracts on the same day. Buyers arriving faster than metal was clearing. The line at the vault window growing longer, not shorter. That is the signature pattern of a bank run. Not a run on dollars this time, a run on silver. And the vault does not have infinite silver to hand out. Now I'm going to do something that most silver channels refuse to do. I am going to give the bear case its full day in court. Because if you are going to make one of the most important financial decisions of your life based on this data, you deserve to hear the strongest counterargument, and you deserve to hear why, even after considering it carefully, the bull case still stands unshaken. The skeptics argue that open interest is not equivalent to physical delivery demand. They say the majority of futures contracts are rolled, closed, or cash settled before delivery ever begins. They say the viral claim of 400 million ounces of open interest against 100 million ounces of registered silver does not mean the exchange is approaching default. They point out that delivery often involves the transfer of a warehouse receipt, not necessarily a physical truck pulling metal out of a vault that same day. Ownership can change hands on paper without the metal physically moving an inch. These are legitimate structural points, and they deserve honest acknowledgement. And parts of the skeptical case are genuinely strong. I will be honest with you. Major delivery months behave differently from minor delivery months. Open interest is a dynamic number that fluctuates every single day. The mechanics of how COMEX actually processes deliveries are widely misunderstood, and some of the loudest voices in the silver community are getting specific calculations wrong. One prominent analysis even assigned a probability of approximately 0.001%, roughly 1 in 10,000, to a formal COMEX default in March. That is not a number born from emotion. That is a disciplined attempt to counter the collapse narratives with precision. But here is the fatal flaw in the bear case. They are answering the wrong question. The question is not whether COMEX will formally default tomorrow morning at 9 o'clock. The question is whether the structural drain on physical silver, the 15 consecutive months of record outflows, the 75% decline in registered inventory from its peak, the 820 million ounce cumulative deficit, the Chinese strategic reclassification, the insatiable industrial demand, the institutional pivot to physical ownership, and the premiums blowing out in physical markets around the world add up to a market that is fundamentally broken in a way that the current price does not yet reflect. And the answer to that question is an unequivocal yes. You do not need a formal exchange default for silver to triple from here. You just need the market to collectively realize that the metal is scarce, the demand is growing, and the price is wrong. That realization is happening right now, in real time. In every single data point we have examined today, the awakening has begun. The skeptics are correct that COMEX will probably not default next week. But they are catastrophically wrong if they think that means the price is fair. The price of $69.82 is a number set by a paper market that trades hundreds of times more silver than physically exists in its vaults. When the paper market and the physical market diverge, it is not the paper market that gets to declare the truth. It is the physical market. And the physical market is screaming that silver is historically, dangerously, structurally underpriced. We are entering what I call the unobtainium phase. The 474 million ounces delivered in 2025 have sucked the wholesale market dry. The December and January record months have depleted reserves that took years to build. When the wholesalers run out, the retail shelves go bare. The buy button disappears. We are already seeing delivery delays stretching weeks into the future for certain sovereign coins. The window of opportunity to acquire physical silver at these prices is closing, and it may not reopen for those who hesitate. The risk is not that you buy too high. The risk is that you cannot buy at all. That is the asymmetry that makes this unlike any other trade in the entire market right now. The downside is limited by industrial demand that puts a structural floor under the price. The upside is unlimited because no central bank, no government, no institution on this planet can print a silver bar. You cannot fabricate scarcity away. The Federal Reserve can print dollars. The Treasury can issue bonds. The banks can create paper contracts until the end of time. But none of them can create a single troy ounce of physical silver. It is element 47 on the periodic table. It is forged in the thermonuclear furnaces of dying stars. There is a fixed amount on the crust of this earth, and we have already mined the easy deposits. What remains is deeper, harder, more expensive to extract, and further from production with every passing quarter. You cannot print your way out of geology. So here is where we stand. Silver at 69.82 and pressing higher. COMEX registered inventory at 79 million ounces and pressing lower. London Vault silver at 27,065 tons and declining month over month. Delivery notices active and accelerating through March. Industrial demand vertical and growing across solar, EVs, semiconductors, AI, and 5G. Chinese silver exports shut down entirely. Cumulative supply deficit at 820 million ounces. ETF premiums expanding above NAV. Mining stocks surging 5 to 8% in single sessions. Institutional capital flooding into physical vehicles at unprecedented scale. And the paper market is sitting there pretending everything is perfectly fine. It is not fine. What we are witnessing is the slow-motion fracture of the paper-silver market, not with a single dramatic crack that makes the evening news, but with 1,000 small fissures spreading through the foundation until the entire structure gives way under its own weight. The warehouse reports are the seismograph. The delivery notices are the tremors. The ETF premiums are the ground shifting beneath the surface. And the spot price is the last thing that will move, because the price is the last domino to fall in a chain that has already started toppling. But the price always catches up to reality. Always. The London gold pool tried to suppress gold in the 1960s. It collapsed in 1968 when the vaults ran dry. Nixon tried to fix prices in the 1970s. The market broke through every ceiling he erected. The bullion banks have tried to cap silver with paper for 4 decades, and it is failing right now in front of our eyes, one warehouse report at a time, one delivery notice at a time, one declining London tonnage figure at a time. The pattern is identical. The hubris is identical. The outcome will be identical. The 79 million ounces of registered silver is the last line of defense. When it falls, and at the current rate of depletion, it is a matter of when and not if there will be nothing left between the paper price and the physical truth. The price will not adjust gradually. It will gap. It will teleport. You will go to bed with silver at 75 and wake up with silver at 120 because the market will discover overnight that the paper emperor has no metal and never did. This is the greatest asymmetric trade of our lifetime. It is not a gamble. It is arithmetic. When demand exceeds supply by 820 million ounces, and the vaults are draining at record speed, and the world's largest exporter has locked its doors, and the technologies of the future all require this one specific irreplaceable metal, the outcome is not uncertain. It is mathematical. The only variable is timing, and every single data point from every single source is telling you the timing is now. Do not let the noise distract you. Do not let the day-to-day price volatility shake you out of a position that is backed by the most powerful fundamental setup in the history of the commodities market. The paper price will get smashed on a random Tuesday morning to shake out weak hands. The talking heads will go on television and tell you silver is overbought and due for a correction. Smile when they say that. Thank them for the discount. And stack harder than you did the day before. Because one day very soon, the warehouse report is going to print a number so low that even the mainstream media cannot ignore it. One day, the delivery notices will exceed the registered inventory, and the exchange will face its moment of truth. One day, the premium on physical silver over the paper price will blow out so wide that the two markets disconnect completely and never reconnect. And on that day, the people who listened, who tracked the data, who understood the structure, who held the metal in their hands while the world laughed, will be standing on the right side of the greatest wealth transfer in modern history. The vaults are draining, the clocks are ticking, the metal is moving east and it is not coming back. The price at $69.82 is not a ceiling, it is a launch pad. And every single data point, every warehouse report, every delivery notice, every declining London vault figure, every ETF premium, every mining stock explosion is pointing in one unmistakable direction. Up, I am market cipher, and the silver squeeze is not a theory anymore. It is in the data, it is in the vaults, and it is coming for the price. Like, subscribe and share this video. See you on the other side.